On January 1st, 2007, Barclay Company sold property for $200,000. The note will be collected as follows: $100,000 in 2007, $60,000 in 2008, and $40,000 in 2009. The property had cost Barclay $150,000 when it was purchased in 2005. Now the instructions are to compute the amount of gross profit realized each year, assuming Barclay uses the cost recovery method, and then compute the amount of gross profit realized each year again, assuming Barclay uses the installment sales method. Okay, we'll tackle the cost recovery method first, and now you see the solution on the screen, and let's walk through it. Alright, now the cost recovery method says we don't record any gross profit until we have recovered our cost. So the opening cost was $150,000. So in 2007 we received $100,000. That leaves us a balance of $50,000 that still needs to be recovered before we can record any gross profit. So for 2007 we're essentially $50,000 in the hole yet before we can record any gross profit. So the amount we record is zero. Then in 2008 we received $60,000 of cash. Since we had another $50,000 yet to recover, then we can record the first $10,000 of the gross profit. Then in 2009, when we receive the last $40,000, we can record all of that as the gross profit, since at this point we've already recovered all of our cost in the property. And that's how we would approach Part A. So the answer is 0 for 2007, 10,000 for 2008, and 40,000 for 2009. Now on Part B we're asked to compute the gross profit using the installment sales method. Okay, now you see the solution on your screen. Well, the gross profit rate is what we need to calculate first. So 200,000 less 150,000 is the amount of our gross profit, and then we divide it by the sales amount, 200,000, and we wind up with 50 divided by 200, which is 25%. So of the 100,000 we receive in 2007, we can record 25% of the total 50,000 we expected to earn in gross profit. So 100,000 times 25% says the gross profit we can realize is 25%. Then in 2008, the cash received amount was 60,000. We take 25% of that, and we are then recording 15% of our 50,000 of gross profit in 2008. And then finally in 2009 we take the amount of cash we received times the gross profit rate again, and we record the final 10,000. And that's how we would approach Part B, where we would calculate gross profit using the installment sales method.